You want to get started investing and don't really know where to start. You know that you need to invest, but there's so much information out there that it could be a daunting and scary thing to look into. Maybe the only things that you have seen or heard are people getting crazy rich or losing everything. Well, in today's video, I'm going to be going over the different types of stocks you can buy, the true cost of not investing at all, and 3 actions that you can implement today that will help you grow your financial future by investing in the stock market. What's going on, everyone? And thank you so much for tuning in to my channel. My name is John, and I'm a 27-year-old real estate and stock market investor whose goal for this channel is to help you achieve your financial goals through planning, investing, and saving money. If you like the content, don't forget to drop a like on the video because it really helps out small channels like mine continue to grow. And also to subscribe to be notified for all new content that's coming up. So with that, let's get right into the video. According to a recent survey done by Gallup, the average age that people start investing is 29 years old, and only 26% of people begin investing before the age of 25. A lot of people usually think that the stock market is a very risky investment. Now, while that can be true and you can lose money, historically, this just isn't the case. Personally, I believe that not investing at all is actually much more of a risk to your financial future, and later in the video, I'm going to be showing you exactly why that is. Now, while investing in your late 20s is a good time to start, starting as young as possible can be the difference of hundreds of thousands of dollars. For example, if we take the same $100 investment every month and see the difference of starting at the age of 25 versus the age of 29, it's over $116,000 of difference in just a 4-year time span. Even if it starts with a quick $50 or $100, any little bit can help. And in fact, the #1 problem people, according to a Yahoo Finance article, face when looking into investing in the stock market is that they think that they don't have enough money to start, when in reality, any small amount can truly help grow a small account. Now, many of the best investors in the world believe that time in the market is better than timing the market. Meaning it's better to have your money invested for very long periods of time than attempting to get in at the exact perfect time. It's impossible to time the market exactly, and anyone who tells you that they can is really just lying to you. By being in the market as soon as possible, it allows your investments to grow year after year for 20, 30, or even 40 plus years. Now, there are tons of different ways to invest in the market, but the key when you're starting out is to keep things simple. By just understanding a few simple types of stocks, it will help you make better investment decisions and allow you to grow your investment account over time. There are a few different stock categories that we should really know about. First is growth stocks. These stocks are usually companies that are growing very rapidly and have a lot of potential. Some examples of growth stocks would be ones like Amazon and Tesla. The benefits of growth stocks is that they can grow very rapidly and extremely quickly, but a con is also that they can go down very quickly in a matter of a couple days. Second is value stocks. These tend to be much more mature companies that have been around for many, many years and are seen as being cheap in relation to things like their sales or their earnings. Think of companies like JPMorgan or Exxonmobil, and although they may not grow as quickly as, let's say, a growth stock does, they may not go down as fast either. Next, we have dividend stocks. These are companies that will give you a dividend or payment each and every quarter for simply owning the stock. They are typically, once again, very established companies like 3M. These companies can be similar to value stocks in that they may not move as quickly as, let's say, a growth stock, but they may also provide a small bit of income for you if the correct ones are chosen. Fourth, there are defensive stocks. Think of names like J&J, Coca-Cola, Procter & Gamble. These stocks tend to trend with the market and are much safer investments long term. In all market conditions, these can be safe investments. However, a con is that if the market is going up very rapidly, they tend to trail behind the market quite a bit. Fifth, and the riskiest, are known as quote-unquote penny stocks. These are stocks that you see in movies like Wolf of Wall Street. And they are very small, unknown companies that typically trade under $5 a share. Now, don't let the small price tag fool you. These are very risky investments, and you can make a lot of money very quickly if you know what you're doing, or lose a ton of money if you have no idea what you're doing and just trying to invest and make a quick buck. Sixth and finally are cyclical stocks. These stocks tend to trend in correlation with the market. So if the market is up, they tend to be up, and vice versa. Think of companies like American Airlines, Marriott, and GM. They're in industries that typically trend with the market and the economy, like car manufacturing, hotels, and airlines. So once again, they can be good investments when things are going well, and pretty poor investments if things aren't going well, if we look at things like 2008 as an example. Now, usually when you invest in individual companies, you should do some research and understand a lot about what they do. But if you wanted to make a much more passive approach to investing, you could invest in something known as an index fund. An index fund allows you to invest your money in what the overall market is doing. So for example, instead of only owning one share of, let's say, Tesla, you would own partial shares in a variety of different companies like Apple, GM, Home Depot, and many others. An index fund trends in the exact way that the market does and is the most passive way of investing overall. This is typically how many people invest in things like a 401k plan or other retirement funds. I mentioned earlier that I would show the real risk of not taking action and investing at all. Let's take a quick, simple comparison of investing the same amount each month in the stock market versus, let's say, a savings account. Over the past 90 years, the average return in the stock market has been around 10% a year. And let's even accommodate for something like inflation, which is typically 2 to 3% a year. This will net you a return of about 7 to 8% annually. On the other hand, let's now look at the average savings rate in America, which is typically around 0.09%. No, not 9%, 0.09 of 1%. If we take that same amount that we saw before of investing $100 a month from the age of 25 to 67, which is the typical age of retirement, versus that same $100 a month invested in a savings account, making you 0.09% on interest, the results are really astounding. The difference is over $360,000, which is an astronomical amount of money when you're going into retirement. Now, I understand that many people will say, well, you can't lose money in a savings account, which really isn't true if you look at inflation. And also, haven't a ton of people lost a lot of money in 2008? Now, while some of that is true, a key point to keep in mind is that as long as you are a long-term investor, you don't panic, and you let history to continue to repeat itself, in the long run, you will always be much better off leaving your investments alone. Don't panic sell and have much more money in your accounts years down the road. Okay, so we have covered off on types of stocks or index funds that you can invest in, the true risks of not taking action at all. Now let's take a look at 3 actions that you can take today that will help mold your financial future. Number 1, start a Roth IRA or brokerage account and fund it today. Now, you're probably thinking, what the heck is a Roth IRA? A Roth IRA is an individual retirement account. What this account allows you to do, as of the recording of this year, is contribute up to $6,000 a year if you're under the age of 50 years old, or $7,000 a year if you're over the age of 50, into a retirement account for yourself. The money that you contribute is known as quote-unquote after-tax dollars, simply meaning the money that you get paid or have after you've paid taxes to your job. Now, the beauty of this account is that any gains that you make in the account are completely tax-free, meaning when you are ready to retire, all of those gains that you have had over the past 20, 30, or 40 years have had no tax implications on them. You do not have to pay 1 penny in tax. If you contribute the max amount each year from the age of 25 to 67, you will have over $1.6 million tax-free in this account. And that's just assuming a typical 7 or 8% return. Now, there are some penalties if you try to withdraw any of the gains before you are 59 and a half, unless you have a few extenuating circumstances. But you are always able to withdraw the money that you have put in without penalty or any tax. Now, on the other hand, you have a brokerage account, which is the most common way investors use to buy and sell stocks. The difference with this account is that it doesn't just have to be used for retirement. You can simply buy and sell, but any gain that you have in this account will be subject to a capital gains tax. Both of these accounts are extremely easy to set up and can be done in as little as 10 minutes or so. The companies I recommend for Roth IRA are companies like Vanguard or TD Ameritrade. In terms of brokerage accounts, the 2 that I personally use are Robinhood and Webull. Both have apps that make the process very easy to do and download, and trading is completely free as well, which is kind of unusual. In fact, Webull has a promotion going on right now that if you sign up and deposit $100, you get 4 free stocks automatically, which can be valued up to $3,700. It's by far the best promotion that I have seen in the industry, and I don't know when it's going to be done, but I highly recommend you take a look into it. Links for these signups can be found in the description below. The second action you can take right after opening up that account is to set up automatic investment. What automatic investing allows you to do is invest in the account on a specific time frame. So for example, daily, weekly, bi-weekly, or monthly. This is a phenomenal way to almost set it and forget it. By doing this consistently, your investments grow surprisingly quickly over time, and before you know it, you'll have a good amount of money in this account. For example, let's say that we want to invest $10 a day, so maybe one less Starbucks coffee and one less breakfast sandwich in the morning. If we take a look at the same time frame of 25 to 67 that we've been using for this entire video, we would have about $1.2 million in this account. Now, the crazy part about this is that over that 40-year time span, you would have only invested $150,000. So that rest of that $1 million is all completely gains. Third and finally, if you're a little bit more tied up for money, you could always download a free app like Acorns to help you get started. What Acorns does is it rounds up spare change of all of your purchases and will invest it for you automatically. So for example, if you buy a coffee for, let's say, $2.25, it will round that up to $3 and invest the 75-cent difference automatically for you. The service costs around $1 a month, but it's a great way to start investing in an account, even with spare change. So there you have it, 3 quick and easy ways that you can implement today to help get you started investing in the stock market. If you enjoyed the content and got any value out of it at all, please make sure to drop a like on the video and also to subscribe for more content. Once again, thank you so much for tuning into the channel, and I'll see you in the next video.